If you want to get into real estate investing, but you're not quite sure how to start, this video is going to explain all of your financing options, and there's a bunch of different types when you're getting into real estate investing. So let's just start, and I'm going to do a breakdown from some of the easiest to get and some of the toughest or different types. Hey, before we get started, please subscribe to the channel. It'll help me grow and it'll give you some great information. I hope you enjoy this video, so let's get going. If you're a first-time investor, there are the FHA, the VA, and the little known for rural areas, the USDA. So let's just go quickly and break those down. I've done videos on a few of them and I'll do some more. So the first one we're going to break down is the FHA loan. And the FHA, you could buy up to 4 units. So anywhere from a 2-family to a 4. When we talk real estate investing, I consider that multifamilies. And for many reasons, I don't think condominiums or single-family homes are the best option. We'll do a video on that in the future. But if you think that single-family or condos are a great option for investment, leave a comment below and let me know your thoughts. Appreciate it. So the FHA loan, it's 3.5% down. You can buy up to 4 units. You have to live in the unit for a year, and it's a good loan to start out in. The home has to meet many requirements. And again, I have a video on that. You can check that out. Second one is a veterans loan. It's called the VA loan. This one is wonderful. You have 0% down for eligible veterans. It could be up to the 4 family against. There's no private mortgage insurance, which saves you a ton of money. And in a lot of cases, the interest rate is going to be below the market interest rate. A lot of banks offer a 0.5 point below, so that saves you hundreds of thousands of dollars. USDA loans, it's 0% down for rural properties. These are multi-families in small towns. I'm in Connecticut. We actually have some rural zones in Connecticut. Again, must be owner occupied. There's income limitations, and it's only for certain areas. So you could check with the lender if they handle USDA loans, if you're thinking of more rural areas, and see if there's any designated areas in the area where you live. Next loans are between 5% down and 20% down. A little more difficult to get. Credit scores high 600, 680 plus, and it's best if you have an over 700 score. 750 to 800 is optimal. These are conventional loans and they're competitive interest rates. The credit requirement is the good thing, but you can get a great rate. So conventional loan is a great option. And here's the thing, a lot of lenders are now offering the low down payment for the multi as low as 3% down on a conventional loan. So ask your lender. If you're going to go with a lender, look for a portfolio lender. Again, many may offer these low rates if you're the first time buyer of a multi, the 3%, 5% down. Local banks keep their own mortgages. They hold them in-house. So they have a very different underwriting process. There's actually a small board. They sit around, they get to know you. They work with unique properties, and they are one of the best funding options, I believe, out there for young real estate investors, builders, etc. DSCR loans. They're called debt service coverage ratio. That means they want 15 to 25% down. A lot of these groups, you need money if you want to get into real estate investing, and there's a good reason for it because you need some backup. Qualification is based on the cash flow of the property, not your personal income. So if you have money saved and you're self-employed and your income varies, these are good to look at. They're good for scaling your portfolios. They typically have higher interest rates, but a lot of new investor real estate entrepreneurs love these type of loans and they work very well. Third type of loans, they're 20 to 30% down. They have easier qualifications, but you do need to have that extra capital. They're used for 5+ unit buildings. These are commercial lenders. They're a little more strict than DSCR requirements. A lot of their type loans have interest only with balloon payments, only good for 5 to 10 years, usually 5 with a 5-year option. So these are the type of loans you can get. They're going to cost you less out of pocket, and it's ideal if you're buying like an apartment, small apartment building. You're going to improve it and you're hoping to sell it at a profit or refinance it with a permanent loan after you fix it up. Hopefully you've gotten your appreciation value in there and you've upped its total income output. People new to investing like to go to hard money lenders. There's very easy qualification as long as you have 20 to 30% down, fast closings, very little documentation, very high interest. probably one of the higher interest rates. In the old days, we would call these guys loan sharks, but they serve a purpose out there. For people that want to get into the flip business, these people are a good source. They're usually 6 to 18 months if you're going from one property to another. Private money. You may have a family member that sees something in you and they're going to loan you money to do the deal. And now you're negotiating direct with a family member. They could give you a good interest rate, a lower down payment, flexible qualifications, and it's all about your reputation. Let's just say you're a plumber and you have a wonderful business and you want to start getting into real estate, and one of your best customers says, hey, I'll back you up. And they do it because they like you and they're going to give you favorable terms. That's a great way to look. Is if you're a small business owner, look to your customers. Don't be afraid to ask. You never know. People that have money like to invest money. What about seller financing? I have a client that has started his whole career with seller financing. Now, he did need the down payment, so 10 to 20%, and seller financing, 5 years with a 5-year balloon. They work pretty much like a commercial lender, no bank involvement, and a seller who's tired of his property will give the right person a good deal and at favorable terms. That's the old adage. You have to have your ear to the ground. You have to be out there pounding it out and trying to figure out how to find these people that have properties that they're tired of. Let me know if you think that's a good option, seller financing with properties they're tired of. And if you would like to know about this type of subject, leave a comment below. I appreciate hearing from you. What about like a joint venture or a partnership? You have the expertise. Let's just say, again, you're a plumber, electrician, you're very good with your hands, you're a carpenter, and you could take a building and you can clean it up, fix it up, and make that cash flow really improve. And then you have somebody who's your professional partner, a friend that's in the professions and doesn't have the know-how, but can put up the money. So you could do a partnership, and you have to be very careful. You want to have a good agreement. Who's operating, who's managing. It's very important because you just don't want these things to go sideways. Oh, I want to sell. Well, I don't. I want to fix. I don't. You just don't want to get into that. You want to go into it with your eyes open and both be on the same page when you're getting involved with another person. What about a home equity loan or HELOC? Use your home's equity to purchase a multifamily. Could be very controversial, depends on how much equity you have in your home, and it depends on, are you risk averse? Are you willing to take big risks? It's a scary one, and I would use that as the last alternative. Keep your equity, but that's just my opinion. A lot of people would say have the biggest mortgage you could have all the time until you die. So again, that's a potential. You could borrow money to do whatever you want with it, and you could go and buy yourself an investment property. This is a very interesting one, and it's, when I look at these are kind of complicated, but they're available. So you have an IRA. They call it a self-directed IRA, and they don't require any down payment in the traditional sense. Retirement funds can be used to invest directly in real estate, and there's a lot of rules with the IRS, very strict. You can't personally benefit or commingle these funds. So what does that all mean? Well, I'll get into it right after this next one. Crowdfunding platforms. This is passive. You can invest in crowdfunding platforms, usually $500 to $5,000, and you have no management responsibility. Returns vary, limited liquidity. I don't really like them. So on the SDIR, self-directed IRA, let's just say you have a lot of retirement income and you want to diversify it. So you purchase a multifamily with it. You could purchase single family land. You can invest in real estate syndications. You can do a lot of different stuff with it. You can't live in the property. You can't use it for personal benefit from the property. It must be for investment purposes only. And your accountant would go over all these things with you. This is one that you really need professional guidance on. All the income goes into the retirement fund, and all the repairs, taxes, insurance, and expenses come out of the retirement fund. You're using your retirement fund to build equity. You're using real estate as the source of building that wealth. And then when you retire and you start drawing on that or selling it, you're going to be paying the taxes. And again, that's something to go through professionals that have expertise in these type of loans. So you can't personally guarantee the mortgage, that they're non-recourse. A lot of times people syndicate. I have $40,000, you have $60,000. We put our money together in a syndicate and we purchase a flip or whatever, but again, it's all done with these very strict rules. Usually these are used as what they call tax shelters. One last thing on the crowdfunding. So you could invest in these crowdfunding platforms. They have one called Fundrise, Realty Mogul, CrowdStreet, Arrived Homes. There's a bunch of them out there, and you invest each has some are as little as $10 to join, and some are $5,000. And you leave everything up to them. And it's a cash flow type of a thing, or equity growth. It's very, very passive. It's, again, you're diversifying, but you don't, it's all based on how good is the platform. So if it were me, I'm invested in like a Vanguard, and they've been around much longer and they have a very great track record. But again, this is something that you could explore and determine on your own whether or not you think this is good for you. So there are the sources of funding for your real estate venture. I hope you find this information interesting and educational, and please subscribe to the channel if you want more videos like this. We look forward to seeing you on the next video. Thanks.